Hello, everyone. This is Rob Jevons with Heffernan Insurance Brokers, and welcome to our webinar today on ESOPs. And I'm just trying to give me 1 second here. I need to check something. And we're gonna, while I'm doing this, we've got we had 122 people register. We've got people still signing on, so we're just gonna give this a few more minutes while the attendee list keeps ticking up here as more and more people log on. So we'll get started here in about a minute. Okay, we're up to 32. We'll just give it another minute or so. Got 34. Let's see, we'll get up to, there we go, 37. All right, we'll get started. So good morning, everyone, or afternoon, depending on what part of the country you're in. Dan is in Pittsburgh. I'm here in Miami, remote today from our Heffernan offices on the West Coast. We're excited for this webinar with our friends at Business Transition Advisors, who are specialists in all things ESOPs. And this partnership kind of derived with the private equity and mergers and acquisitions practice here at Heffernan. We view ESOPs as another excellent exit alternative for privately owned businesses, as a way to sell your business to your employees and all the benefits that come from that, which Dan is going to focus on here in a minute. And I know that most of the people here are already have relationships with Heffernan, so I think I can share you all the Heffernan commercial today. We will assume you're all, well provided for. Heffernan clients or friends of Heffernan, and we just wanted to present this information to you today to give you kind of another tool in your toolkit as you contemplate, perhaps exploring the sale of your business, or maybe you have a client who is considering the sale of the business. So with that, I'm just going to go ahead and kick it off and send it over to Dan and let him educate you all on ESOPs and all the benefits of said plans. Go ahead, Dan.
Wonderful. Thank you, Rob. Appreciate that. Hello, everybody. It's nice to be with you again. As Rob said, my name is Dan Zugel. I'm with the firm Business Transition Advisors, Director/Senior Vice President. And we're a national ESOP consulting firm. I've personally been doing ESOPs with these folks for about 23 years. We work across the country, across disciplines, and as Rob said, pretty much everything ESOP. From kicking the tires to what is an ESOP, all the way through getting the transaction done and giving the great news to the employees. So we love every section of it, every part of it. We'd love to get our hands in there. All coordinated all in one place. But it's not about us. That's it on us. Today's focus is what are employee stock ownership plans, and what are the current design and financing techniques and trends, because ESOPs have changed over the years. So if you've been a part of an ESOP firm, which is employee stock ownerships, a firm in the past, or they're probably a little different than what you remember. And so I thought we'd talk about modern ESOPs, how they work, how they fit, how do we pay for them, and talk about some of the main things that most folks learning about ESOPs or considering an ESOP, talk about most of the things that you want to know. So we start with what is an ESOP, and I know that sounds simplistic and we throw that around a lot, but we lose sight that it actually stands for something and it means something. It's ESOP, the letters of Employee Stock Ownership Plan. It's not a stock options, and people get confused sometimes. They say, boy, I got stock options at work. Well, that's not an ESOP. That's a different type plan. An ESOP is a tax qualified defined contribution employee benefit plan, like a 401k, profit sharing plan. You got to follow discrimination rules, testing rules, contribution limits, all those kind of things. So, and overseen by the Department of Labor and the IRS. And it adds some complexity, to be real with you. However, with qualified professionals like us and other qualified providers out there, you get through the complexity and kind of work your way through that, and you get some really incredible tax savings and tax advantages and other qualitative benefits as well. And because the government's involved, this is maybe one of the key reasons you don't hear about ESOPs every day. We have M&A providers, and Hefernan's a fantastic one, but the vast majority out there don't talk about ESOPs because we have to deal with the government and have to follow the rules. But with that comes some very nice tax benefits, and we're going to go through that. Modern ESOPs have been around since, in the current form, mainly since 1974. It's part of ERISA, Employee Retirement Income Security Act, signed by Carter. Kind of the modern standard for how you run retirement plans these days. Now, they designed ESOPs for the purpose of providing for independent wealth for employees of companies. Both parties really like ESOPs. So when I talk about some of the tax advantages, you might be scratching your head saying, when are they going to close these loopholes? Can't believe these are available. They're going to shut these down. But the fact is, they don't look at these as loopholes. First of all, they look at it as ways of accomplishing financial and social goals. And so both parties like ESOPs coming from different angles. You have the one side of the aisle that says, hey, finally the rightful workers are getting what's theirs. It's the proper redistribution of wealth in America. The other side of the aisle tends to say, that's great. We love people with independent wealth, because the more people with independent wealth, the less people that are going to be dependent upon government safety nets along the way. And the more tax advantages we give businesses, the more they prosper, they hire, they pay more wages, they grow, they expand. And so the end result is both parties really like ESOPs, but kind of come at it from different directions. And you're more than welcome to have this presentation when we're done. However, I'm not going to read these to you, but I do this out of kind of the side of humor. There's not a lot of presentations where you have Bernie Sanders and a Ronald Reagan quote supporting the exact same thing, is there now? So just thought that's kind of amusing. You can read these at your leisure if you want the presentation. Happy to give it to you. The power of employee ownership, well, this kind of goes to the one side that says, hey, finally, workers are getting kind of what they deserve, and that's a great social objective. And so from the employee standpoint, during the 2008 recession, and it's looking to hold true for the pandemic, employee owners were 4 times less likely to be laid off during the 2008 recession, and it's looking like it's holding true from the preliminary studies I've seen during the pandemic as well. So it's job stability, it's there. And this, to me, this is kind of the one of the biggest advantages to the employees themselves. Employees at ESOP companies average 2.5 times greater retirement account balances than their peers at a non-ESOP company. So what this is saying is, all things being equal, an employee at factory A that has an ESOP has 2.5 times the retirement benefit than the factory worker at employment place B. It's just the ESOP accounts grow, and it's a significant additional retirement benefit than a company with just a 401k alone. So it's a dramatic, potentially life-changing retirement plan for the benefit of the employee, and it changes lives, it truly does. Plus, ESOP companies pay higher wages averages, sales increase, job growth, just all the positive things that come out of an ESOP, is so everybody wins, including the government, by the way. We're going to talk about these tax benefits, but when it's all said and done, even though the government gives these, you're going to say, amazing tax benefits, when it's all said and done, from the savings of jobs and the increased economic activity and the increased wages and all the things that are a result of an ESOP, the government actually nets more revenue than they would have than what they're giving up by these tax incentives. So It's not like we're losing money on the deal. In fact, the net benefit is positive to both the states and the federal government. Now, there's 4 major tax advantages here. Some are for C corporations, some are for S corporations. You got to be one of the two. So if you're an LLC taxed as an S, or a sole proprietor, or a partnership, we have to convert you to one of the two. Now, it's generally not a big deal going from a pass-through entity to an S corp. Going to a C corp takes a little more doing, and we have to consider that carefully before we do something like that. But each type of entity has its own advantage of doing an ESOP. And about 20-25% of the time, we can get both tax advantages, depending on facts and circumstances. But let's keep them separate for right now. The oldest tax benefit in ESOP is this. It says if you're a C corp, or you convert to one, and you sell your stock to the ESOP of a C corporation, the sellers can elect to indefinitely defer and then potentially eventually eliminate all the capital gains tax that's normally due in a sale. So you could sell your business and end up not paying any tax on that sale. It's kind of similar to, if you're familiar, a 1031 real estate exchange. People are generally familiar with that. You have an old piece of land in the family, you sell it and buy another piece of land, which is a like property, like kind exchange. You don't have to recognize a gain. It's just the basis of the original land is now the tax basis of the new land you bought. Same thing for life insurance. It's called a 1035 exchange. You have an old policy and your agent says, I have a better policy for you. And you give up that one and you buy a new one. Your basis transfers from your old policy to your new one. You do not recognize a gain. So that's 1031, then 1035. Well, 1042 is the code section that does the same thing, but specifically for ESOPs. It says if you're an owner of a C Corp stock and you sell your stock to the ESOP, as long as you reinvest the proceeds into US domestic stocks and bonds, your tax basis of your original company, which is probably very low, now becomes the tax basis of this brand new stocks and bonds that you bought. You do not have to currently recognize a gain. And then eventually, through some techniques and at death, your family gets a stepped up basis at death and you never pay the capital gains tax. So that's an incredible tax benefit, but you got to be a C Corp to get it. I'm going to skip to number 3. Number 3 is generally considered the bigger tax advantage currently. Now, that's kind of amazing, right? Not paying tax on the sale proceeds. But this can be quite staggering, and this is game changing. To the extent a company is a 100% owned S Corp, in the ESOP owned S Corp, once a company is that, becomes a 100% ESOP owned S Corporation, the profits of the company cease to be taxable. Cease to be taxable. There may be some franchise tax, but as far as income tax goes, the taxation goes away. And it's quite simple. We'll talk about that. But because the tax form goes to a retirement plan, not an individual. And we'll drill down on that a little bit more. So traditional federal and state income taxes on profits of a company that's 100% ESOP owned, taxes cease to be paid. Pretty amazing. And that's the tax savings is what pays off the debt we may have incurred to buy 100% of the company. We're using what used to go to the governments is now being redirected to pay the seller and the bank off for the stock that was purchased from them. Quite amazing. Now, I skipped back to number 2, and that's an S Corp advantage, by the way, number 3 there. And number 2 is an S or a C advantage, if it's relevant. And the reason I skipped to number 3 first was if you're 100% ESOP owned S Corp and the profits aren't taxable anymore, you're never going to worry about deductions again, or depreciation or write-offs, because the company's not subject to income tax. But if you're less than 100% ESOP or a C corporation ESOP, number 2 becomes relevant. There's a dollar for dollar corporate income tax deduction for every dollar's worth of stock that's sold to an ESOP. So it could be a very substantial deduction annually to the companies, a big old deduction every year up to the value of the business. So if you are paying tax or you're partially ESOP, this becomes relevant. But probably 75 to 80% of all new ESOPs take advantage of number 3, which says your profits are no longer taxable, which is the money we use to pay off the debt, which makes number 2 irrelevant. And if we can get number 1, which is not paying capital gains tax, that's fantastic if we can make it happen. In about, I'd say 20-25% of the time, we can make both of those happen. And so that's facts and circumstances, we'd have to talk about Pretty neat, huh? You can see where people say, well, that's too good to be true. You know, they're going to close loopholes. We're not going to change that. But nobody's looking to do that. In fact, state after state's looking to increase incentives to do ESOPs. And there's, at any given time, there's 2 or 3 bills in the Senate or US House to actually increase the tax benefits of ESOPs. So nobody's even considering removing benefits. They're only talking about adding it because employees having independent wealth works for everybody. It's a positive, both socially and economically.
Hey, Dan.
Yes, Rob.
Well, if you don't mind, so maybe we had one question that came through, and I thought it might be relevant just to address quickly, since it's kind of it pertains to your last page. Although you might, maybe the registrant who asked the question, some of this answer might be addressed on the slide that you just were on.
Okay.
But a registrant asks, how large do you have to be as a sole proprietorship before you can become an S corp?
Yes, I'm not 100% sure if there's a size requirement, because I've seen S corporations of all different sizes. I think it's more of a taxation thing between your CPA and your company. I think that's more of it, but I haven't seen it really anybody too small or too large to go from an entity to an S corp. I'm sorry, that might have been a little fuzzier than you were hoping for, but that's the best I can answer that question.
Yeah, and I can confirm that, just kind of reflecting back in my estate planning days and some of my kind of earlier business succession planning days before kind of morphing into this current role. You know, I recall working with a mortgage business that had 3 owners, and it wasn't a particularly large enterprise, but they had formed as an S corp just for all the benefits of S corp pass through. So I'm not sure that there is a revenue. I suppose we can follow up on that, but I don't believe that there is a revenue figure that a threshold of that needs to be achieved to qualify as an S corp. I believe it's just more of a tax matter.
Right. You know, I think it might be. I think you're right. This slide does kind of pertain, but coming at it from a different angle. There's more of a practical side of things of where ESOPs work and where they make sense for companies because of a couple things. The complexity, you need to get the tax benefits to outweigh the expense of doing the ESOP, and it has to fit because it's I will say not inexpensive to put in an ESOP, and we can discuss that later. And there's ongoing costs of an ESOP. So generally, ESOP professionals like myself, we generally publish and say, look, the company, in order to for an ESOP to have the greatest chance of succeeding, you generally want payroll of $1 million or more, generally $10 million of business value. Now we've done ESOPs down to $5-6 million of value, which is about $1 million of EBITDA, which is net income when you add, and then you add back to that. Maybe some of those things that maybe shouldn't be running through the business, we can add that back. Depreciation, we can add back to that net income. And so when you get up to over $1 million, $1.5 million of adjusted net income or EBITDA, we're in the range where generally an ESOP can make sense, or 20, and generally about 25 or more employees. So that's kind of the general profile, but this is just, like I said, it's a general profile. Everything's facts and circumstances. We've done ESOPs from $4 to $5 million of value to $450 million of value. So, and everything in between. So we can have a conversation about that privately, because I'm sure nobody's going to ask out loud. But we're happy to have
Actually, we did have one question that came through who asked that question. Could a smaller company, less than 25 employees and lower business value, still be a candidate for an ESOP? I believe you just addressed that question.
And it's possible. The answer, it's possible. We just make sure it does work. If everything lines up, certainly. Okay. I think sometimes, if anybody's ever seen an ESOP presentation before, I think sometimes people try to make it more confusing than it is. And so I'm going to explain how an ESOP works kind of from a high level here. The first 4 bullets actually should be on one page, and then the last one's on a second page. So let's just look at the top 4 bullets. And I often kid around and say ESOPs, it ain't rocket surgery, because I think sometimes people try to make it that way, but the basic structure is not. I kind of close my eyes and think of this as I'm doing it. I say, look, the ESOP, which is a retirement plan, it's like a 401k. It's a qualified plan. It's just like your 401k. It's another plan. It doesn't have any money, doesn't have anything in it. It's just a plan that's ready to do something. So that ESOP, that retirement plan, borrows money from a bank. Let's just say bank in our mind. So the ESOP goes out and borrows money from the bank. The ESOP uses that borrowed money to buy stock from the selling shareholders. The company uses that tax savings I just described, because you're not paying tax anymore. The company uses that tax savings to contribute to its retirement plan every year, which is the ESOP. And then the ESOP uses that contribution to pay off the debt it incurred to buy the stock. That's really how the cash flows. ESOP borrows money from a bank. The ESOP uses that borrowed money to buy the stock from selling shareholders. The company uses the tax savings, because they're not paying tax anymore, to contribute to the ESOP every year. And then the ESOP uses that annual contribution to pay off the debt that was incurred to buy the stock from the seller. And now there's devils in the details, of course. There's a lot of legal paperwork and stuff behind the scenes that make it more complicated, but that is in effect what happens. And then alongside of that, as that's happening, the shares, the stock that the ESOP purchased is allocated to employee accounts over 20, 30, or 40 years. We don't want to give it away all day one, because then what happens if you hire somebody tomorrow? Should have been here yesterday, right? We had free beer yesterday, should have been here. No, we want to make this a longer period of time, 20, 30, 40 years. There's a time to recruit. This is your employee benefit hat now. Hey, come work for us. Stay a long time. We're giving away stock for the next 32 years or 35 years. And come work hard. Every year you're here for 35 years, you're going to get more shares. You work hard and you help grow the value of the stock. The stock is worth more. And then when you leave, we'll buy it back from you. We'll buy your stock back from you. And the company must do that, by the way. So that's kind of a responsibility of the company. They must make a market for that stock. And this is called the repurchase liability. And the best practice is the company use some of their tax savings to squirrel away on the corporate balance sheet to grow cash. So over time, when employees do need to cash out, the company has a requirement to do it, there's money there to make that happen. Now, it sounds simple, and it kind of is in theory, but this is where Heffernan, one of the ways Heffernan really comes in here. There's techniques of what Fortune 1000 companies do to finance long-term liabilities like this. I don't personally do this, but that's why I love working with Heffernan. They have techniques. There's investment products. There's, believe it or not, there's insurance products that are designed to fund long-term liabilities like these. So they're the experts in this aspect of it. So I'd yield to Heffernan on this aspect of it. But I do think it's very important for the company to prepare for that ultimate responsibility to buy back those shares. Rob, do you have any comments on that part?
No, just that, we just from past experience, oftentimes that repurchase liability, when not planned for, it creeps up on businesses later, and is often one of the reasons why ESOPs might have to be unwound. Circumstances where private equity firms have come in and have had to buy out ESOPs because that repurchase liability was not addressed. This would be a topic that if anybody here has interest in investigating some of these solutions further, we can address that at a later time. But the repurchase liability is something we need to be mindful from the get, and to plan for from the beginning.
Exactly. Thank you, Rob. Well, Internal Revenue Code section 1042, we addressed this earlier, so I'm not going to spend a ton of time on it. I have it in here because it wouldn't be a complete presentation without it. But if you would like a hard copy of the presentation, not hard copy, if you'd like a copy, electronic copy of the presentation, happy to give it to you. And you can read some of the details here. But in order to get the deferral, I'm going back to the tax savings now. There's a little more detail on this. This is the provision in tax that's available to C corporations that says if you sell your stock to the ESOP of a C corporation via Internal Revenue Code 1042, if you reinvest it into U.S. domestic stocks and bonds, you can indefinitely defer and then eventually eliminate the capital gains taxes that are normally due on a sale of a business. It's a very nice old school tax benefit and still relevant. But however, the fact is most companies are not C Corps anymore. Most are pass-throughs of some sort. And so sometimes we have to go back to a C Corp or find an exception in the law that allows you to take that C Corp advantage. And it's not quite as simple as going from an S Corp to a C Corp and then back to an S Corp. That sounds like the logical, easy way to do it. The problem is there's some restrictions on that, and there's going to be a waiting period. We're going to be paying income tax on the profits when you potentially could not have been, and which is a hard pill to swallow in many circumstances. So it's not as easy as just converting from whatever you are to C and then immediately converting back to be tax-free on the profits. You might be stuck as a tax-paying C Corp for 4 or 5 years when you didn't have to. And when you're not paying income tax, it makes paying back those loans a heck of a lot easier. So a lot of people do not convert to a C Corp just for that, because they don't want to give up the ability to not pay income tax on the profits. And so now we're rolling into that. The reason profits are not taxed, it's not subject to federal and state income tax, is because it's ESOP owned. Because in S Corp, or if anybody else is any other type of pass-through, it works the same way. The profits of the corporate operating entity flow through to the owners and the pass-through, as you all know. And then generally the owners of the pass-through, well, let me get to the next slide here. Here's how it works in a diagram form. This is how it works every day, right? Tell me if I'm wrong. The company earns profits, you do what you can, you deduct everything you can deduct, you buy stuff maybe you don't need for the deduction. The CPA prepares your K-1, your tax form, sends it to the owner, which is you, many times, or if you're not the owner, it goes to the owners in proportion to their ownership. And in a pass-through entity, the owners of a business, they file a 1040, which includes their share of the profits of the business. And so then the companies take distributions to the shareholders, probably about 40% of the profit, right? Or whatever the taxation is in your state, 40 to 50% of the profits you take out of the company so you can pay your personal income tax. And so then the company's left with 50 or 60 cents on the dollar remaining to grow and to do whatever you want to do, pay off your other debt. However, is that right? I'm sure that resonates, right? You earn profits of the company, you send the tax form to the owner files a 1040, the owner takes profits out of the company so they can pay their income tax in the form of distributions. Well, when ESOP's in place, kind of the same thing happens to a point. The company still earns profits. You're not worrying so much about deductions anymore because you're not paying tax, but the CPA prepares the K-1, the tax form. It still goes to the owners. However, in this scenario, the ESOP potentially is the only owner. You can do partial ESOPs, by the way, but I'm sticking to 100% ESOP because that's the vast majority of ESOPs out there. So the company earns profits. The tax form goes to the owner again, but this time the owner is a ESOP, which is a qualified retirement plan, just like your 401k. The ESOP shareholder owner doesn't file a 1040 because it's not a person. It's a retirement plan for the benefit of the employees. The ESOP files a 5,500 informational report, just like the 401k does, and then the ESOP doesn't pay any tax. So because no tax is getting paid, and by the way, it's not being deferred, it's not being pushed down the line, it just literally goes away. Just like your 401k, tax literally goes away. And so therefore, no distributions are needed to be paid from the company's profits anymore, right? Because the one and only shareholder doesn't need the money to pay tax. So the board of directors, which is the seller, and the seller's family still remains in charge of the board, even post 100% ESOP, they say, look, we choose not to declare distributions anymore because our one and only shareholder, the ESOP, doesn't pay tax. It doesn't need the cash. So we're not going to declare distributions. We're just going to hang on to all that money that used to go out the door so our owners can pay tax. Well, since the owners don't pay tax anymore, that goes right stays with the company. That's the increased cash flow of 40 to 50% that easily pays off the debt we incurred to buy 100% of the company. So we're using money that would have gone to federal and state governments and taxes, now redirected to pay off the loans we incurred to buy the stock from the owners. And then once the owners are paid off, which is very quick because you have a lot of tax savings to do it, usually you're not even tapping into any regular corporate cash flow. Pretty much the tax savings, almost every scenario covers the sale price. And then once the sale price is paid to the sellers, now that you still don't pay distributions ever again, Now that just goes right to the bottom line, and you can use it for whatever you want. You're buying people, you're buying companies, you're buying property, you're expanding products, you're buying facilities. It's really a fun time to run an ESOP company that's 100% ESOP owned that doesn't pay tax when all the debt's been extinguished. It's a real boom, and it's a lot of fun if you're the current president, CEO, or your board, or whoever you are, president. It's really fun to run a company when you're not paying income tax, and it sure as heck helps pay off the debt when there is debt on the books. Just an example, it's a rudimentary example, and kind of the point here is, when you're saving $25.2 million of taxes in a generic example here, and you're not paying that, $25.2 million savings here covers the $20 million company value. So the tax savings alone in absolute dollars covered the entire sale. And then once that's paid off, the original 20 is paid off, it goes right to the bottom line every single year. You're not losing that 40 to 50% out the door that eventually are taxes. It just doesn't happen anymore. It just stays at the company, and you're doing wonderful things with it. And once again, circling back to the employees, as the company's doing wonderful things with the tax savings, you're growing and you're building value. And so the employees that are getting shares every year, when they retire, they're getting shares that are becoming worth more and more and more and more for a happy retirement, which is, once again, full circle why the government likes it. Everybody's winning. All right, to switch gears, any questions, Rob, or any comments you might have before I switch gears?
Nope, you're on a roll.
All right, thank you, everybody, for your attention. I hope we didn't lose everybody yet, Rob. Hope we're still good.
Okay. We're up to 52. More people tuned in.
Outstanding. So people are calling their friends and relatives and telling them to jump on. I love it. Okay, fantastic. Okay. One of the big questions I get all the time is control. Control. Who runs it? If I sell more than 51% of this company, are the employees telling me what to do? Are they going to fire me? Maybe not that direct, but everybody's thinking that, right? Well, here's the truth. Employees and participants of the plan, they never technically own stock. They have a beneficial interest in the ESOP trust that owns stock on their behalf. So they don't directly own stock. It's like me owning a share of a mutual fund. I don't technically own Ford Motor Company, but the mutual fund that I have an interest in owns stock of Ford Motor Company. So when we translate that, that means employees do not have statutory minority shareholder rights. A lot of words there, a lot of word salad there, right? But they don't have legal rights to certain things. If I owned one share of your company, I'd have certain rights. You'd have to provide me certain things to make sure I'm not getting screwed. So you'd have to provide me some things. Well, the employees have no such rights. They cannot call a shareholder meeting. They do not have a right to see your comp package or other confidential information. They don't have a right to that. However, with that being said, they do have protection. There is a trustee, and there are professional ESOP trustees out there. There's institutions and people. This isn't like the bank down the road that has a trust department. This is completely different. They're not just administering Aunt Betty's will. They're ESOP trustees. Their job is to watch over the plan, make sure they're following all the ESOP rules, and the employees are being taken care of. They're the face of the employees, and their sole goal and sole objective and fiduciary obligation is to make sure that the company isn't breaking any laws. They're treating the employees fairly according to the plan documents, and they're trying to grow stock value. That's their entitled job. They own the stock technically, and technically, they vote all the stock on behalf of the employees. Now, with that being said, the owners often say, so they can fire me. And technically, yes. I've been doing this 23 years and done hundreds and hundreds and hundreds of ESOPs over my career. The trustee has zero desire to run your company, zero. What do they know about widgets or engineering or whatever else lumber, whatever else you do? They have zero desire, nor do they have the expertise, nor do they want the legal liability. They want to make sure they're going to take their direction from the board, which is the selling shareholder, their family members, whoever else wants to be the board or is the board can remain the board until you decide to change up the board. It doesn't, the people in control are still the people who control the board. They just have a different owner now. And that's the trustee, who once again has zero desire to run the business. Once a year, they may attend either virtually or in person a shareholders meeting, see the financials, ask some questions and say, have at it, Haas, great job, keep going. I'll talk to you next year. That's about the extent of the ESOP. Now, in my 23 years that I've been doing this, has there been a time where a seller was eventually fired? And the answer is yes, one time. One time. It was in Arizona. When the seller sold, well, in any sale, right? When you sell, you don't own the stock anymore. And so when you sell, the sellers, you would have an employment agreement and you'd agree upon a salary, because we kind of kid around tongue in cheek. You lose your thieving rights. Because right now, if you own the business and there's $1 million in there, you put your hand in there anytime you want. Because that's your money, it's your business, you can have that. But once you sell the business, you give up that right, because you're now you're just a very highly paid employee and board member or presidency or whatever positions you want to have. So you don't technically own it, so you can't put your hand in the piggy bank anymore. Well, my one time in 23 years, we had an owner that thought that wasn't right, got a fair price, we negotiated, had an employment agreement with a salary attached, but that wasn't good enough. He was technically embezzling money, and that's the only time in 23 years where the trustee warned him, and he refused to quit putting his hand in a cookie jar beyond what the agreement was, and they had to fire him. That's my only time in 23 years that has ever happened. I don't know if it's reassuring or not reassuring, but that's my experience, and I know my peers experience the same thing out there in the industry that I see at different events. Switching gears once again. Rob, any questions or any other questions from any participants?
Nothing that we haven't already addressed.
Okay, great. As far as valuation, this is another question I get, first of all, who's in control? If I sell more than 51%, then I get, what value do I get for an ESOP? I hear I get less if I do an ESOP, and that's flat out false. First of all, we serve as the seller's side valuation. We help you get the desired amount you want, often the highest price, not always. Now, so we work on your side of the table, and we representing the sellers and the company. Now, the trustee will hire their own independent valuator. We won't see their valuation, they won't see ours. But we negotiate our side of the table and their side of the table. We negotiate for a price we can all live with. And I've never had that not work out. Or maybe once or twice, and I remember the seller was lying. They hid some stuff that the trustee found, so I didn't really count that. The ESOP is a financial buyer. It's not a strategic buyer. Now, that's when people say, I got 150% of the fair market value of the business. That's generally a strategic buyer with crazy money. ESOP won't do that. ESOP's a financial buyer. If I wanted to come in and look at your business and say, this can be my new career, what's fair market value, willing seller, willing buyer, all relevant things known, what would this business go for? That's what the ESOP pays for, and that's the vast majority of sales out there. However, with that being said, ESOPs look a lot more forward via the forecasts, and if they can be supported, ESOPs tend to value a positive forecast more than other methods. I have found that to be true over the years. And in addition to that, ESOP's probably the friendliest negotiation to sell a business there is. Because the trustee wants to buy the business, they just don't want the Department of Labor saying they overpaid. So our job is to give them all the paper they need in their file that they're willing to pay the highest value possible. And that's routinely done. So you get a very, very fair value with an ESOP, sometimes better than other financial buyers due to the forecasts, and I'm going to get bogged down in discounts, but the discounts in ESOPs are more favorable to the seller. Marketability and minority discounts, things of that sort. But we'll leave that there. We can discuss that at a later date should we need to. All right. Rob, I'm going to go into financing, which is the kind of the home stretch here, but I wanted to see if there's anything you want to comment on or anybody else had to comment on before I get there.
No other questions. I would just kind of follow up with what you're saying there, Dan, with respect to the kind of the various buyers in the marketplace. You know, just to kind of further expand on what Dan just said, when you talk about a strategic buyer, you might have a corporation that would be, you know, where your business would be very similar to the operations of the strategic acquirer. And they feel like maybe your business would enhance their business, provide maybe add more customers to their roster, or something in line with the strategic strategy, where they would kind of roll you in and tuck you into the existing operations of the business. In many cases, in that scenario, the current company would cease to exist. the company's current brand would no longer exist. So that's something you would have to consider when you're contemplating the sale of your business. Again, this is something that we can have a conversation on the side versus a private equity buyer, which is another type of financial buyer who might purchase your company and continue to operate that as a standalone entity, maintaining the brand of your business. But they are financial engineers, and they're going to look for various levers to pull to kind of add value to your business. Some of them may be favorable, unfavorable, especially as it pertains to your employees, which really is kind of one of the most important features of these ESOPs, which is people who find themselves most interested in ESOPs are folks that are benevolent and most interested in the kind of the future and of their employees. They want to make sure their employees are taken care of, and that's one of the key points of these ESOPs that we're trying to drive home.
That's absolutely true, Rob. Yeah, thank you for saying that. I get bogged down on the financial side of things, but just what's good for the employees, and frankly, if we want to get a little selfish, which I don't mind, it does preserve the family and community legacy. You're known as instead of old man Bill that sold to the highest bidder and laid off half the plant, or your Bill that was so nice that sold the business to the employees, got his money, maybe not as quick as an outside buyer, but everybody maintained their job, and the family portrait's still in the foyer, and you're still kind of a hero in that town. I'll tell you, it's quite heartwarming to business owners that say, "Man, I almost sold to the highest bidder, but I was worried. Now my former employees in the communities thinks of me as a hero for ultimately giving the business to the employees over time." So just some of the fuzzy stuff, but I'm not going to get too bogged down in. But I'm sure you think about that. Sometimes it matters, sometimes it doesn't. Well, okay, now getting into financing. This is kind of the home stretch here. This is kind of the two big things to make ESOP work in modern design and ESOPs. Is the fact that we can potentially not pay income tax on profits. That's the money. We found the money, but now how do we finance it? So we have enough money generally to pay off debt on 100% bank financing if we could get it. The problem is you may have experienced, the banks aren't going to lend 100% of the value of the company. So it's like you have the cash flow to do it, but they're still not going to lend it. So what we do is a combination of bank financing, and then the seller does some financing in the form of not lending the company money, but just getting paid over time in some installment notes. So maybe half up front, the other half over a period of years, depending on what cash flow will support, which is easier when you're not paying tax, of course. But we do give significant incentives and benefits to the seller for bearing that seller installment notes. And I'll get to that in a second because that's the exciting part. I'm using this as an illustration here. I'm not saying to do this. However, if a business wanted to finance 100% of the value of the company, you could probably do it. And Rob I'm sure can support this. There are people that live out there. They're saying, look, hey, I'll sit behind the bank. And right now it's not on the 3 end, it's more like the 5 end. But you have people that'll sit out there and say, hey, I'll sit behind the bank. I'll be interest only. I'll only get paid if the bank gets paid. I'll sit back here and take all this extra risk. But you better believe I'm not taking the 5% the bank's charging. I need 8 to 12% to sit in that circumstance, right? You would do that. That's what you would do, and I would do that. If you're sitting in that position, you deserve to be rewarded for sitting in that position. So I'm not saying to do that, but we could, in theory, find somebody willing to lend 100% of the value of the company. However, we say, look, maybe not do that. First of all, the bank, the senior lender doesn't want to participate in that. So if you're paying 12% out the door to somebody else, it's harder to pay us back. We don't like that. We're out. The trustee says you're paying 8 to 12% in interest. You're hurting the value of the stock. And so it's not going to grow as fast. And then from your standpoint, which is what we're concerned about, any interest you get is taxable as ordinary income. So you're losing almost half of that to just income taxes anyway. So it's not the rate of return it looks like. You're losing a bunch of that. So what we say is, why don't you take installment notes for anything above what the bank will lend, and you deserve a market rate of interest. You deserve that market rate of interest. So then the question is, well, what's the market rate of interest? Well, we just determined that, didn't we? We just said it'd take 8 to 12% we'd have to give you to bear that kind of risk. But we say, let's not do that. So instead of paying somebody else 8 to 12% to bear that subordinate debt. That's just lost money. Instead of paying you just that 8 to 12%, which the trustee doesn't like, the bank doesn't like, how else can we get you, the sellers, that total return without just giving you that total rate, that interest rate? And that's the really cool part of this. Oops, I did something. Oh no, excuse me. There we go. I've never done that, but I couldn't do that again if I tried. So what do? We say to the sellers, why don't you bear everything of the bank will not lend? You bear that. And so you take installment notes at 5%. You match the bank, but you're leaving something on the table, right? You maybe got 40 to 50% of your money up front. You got your other half of the money roughly over a period of years, maybe 4 to 8 years, 10 years, whatever the cash flow works out. But instead of taking the 10 to 12% you were owed, you only take 5. So you're leaving something on the table. But what you're doing is making the bank happy, you're making the trustee happy, you're lowering your income tax burden, but you're leaving something on the table. And so how we make that up to you is once you get everything you were owed, you had half up front, the other half over time at 5%, the 100% of the sales price is paid out. You got all of it in your pocket. But you say, wait a minute, I left something on the table, remember? Yes, we do remember. And how we reward you for that is when all of that's done, when you got 100% of the sale price in your pocket, the sellers get an additional check of about 20% of whatever the then value of the company is as the reward for bearing that seller debt. Not 20% of the growth, it's about 20% of whatever the then value of this tax-free company is, in addition to 100% of the sales price you've already received. This is the reward for bearing the interest-only seller debt, as opposed to just taking a 10 to 12% interest rate. It works out generally a lot better when we do the math. Here's an example. Let's just say you get a $20 million valued company. The first $8 million comes to you. That may be taxable as capital gains or not, depending on that. Remember the capital gains tax issue? We may or may not get that. It'll either be taxed as capital gains or taxed or not taxed at all. Same thing with the seller note principal that you may receive over 4 to 10 years. That's taxed as either capital gains or not taxed at all. But then we have the reduced seller note interest. We reduced it from like the 9 or 10, the 10, 12, whatever you would have been owed, reduced it to current rates, get another $4.5 million, and that's taxable as ordinary income. But then this $20 million company, we projected it to grow at 3% over 15 years. That just happened to be this client. Doesn't have to be, usually not 15 years at all, but growing 3%, which is very conservative because this company's not paying income tax. Companies that don't pay income tax grow considerably faster. But in this scenario, at only a 3% modest growth rate, that future equity stake payable to the seller, in addition to the $20 million sales price, is about another $6 million go to the sellers for rewarding them for bearing that subordinate notes. And that's taxable as capital gains, not ordinary income as just getting higher interest would have been. And that's not capped. So if this company grows from 20 to 30 million, which is very, very likely, or say it doubles, that 6 million might be 8, 9, $10 million. You don't know, it's not capped. And so the higher the company grows, that 20% of it is growing too. And that's what the sellers get as their reward, no cap. So you want to work hard and grow the value even higher and higher and higher. Well, you get 20% of whatever the result is. And when all the other debt's paid off, 100%, you get that other check. And in this scenario, another $6 million. Pretty neat. So for a total of about $31 million in this fairly conservative example on a $20 million company. This is about, this accounts for about 80%, 75 to 85% of all new ESOPs across America is combined using the tax savings of not paying income tax on profits, redirecting that to pay off the debt, and then having the seller bear some seller debt with a reduced interest rate with a reward kicker of a warrant or a future equity piece. When all the other debt's paid off, the seller gets another bite of the apple because they bore some interest-only subordinate seller debt. This is very, very popular. And like I said, about 75 to 85% of all new ESOPs across the country doing it this method. Doesn't have to be, but this is the most popular. I just said a lot there. I should probably take a stop and see, Rob, if you have any comments, if anybody has any questions.
No comments, but I would kind of going back to some of your one of your prior slides. We did have one registrant ask, are there any, without stealing your thunder on where you are currently in the presentation, any rules or restrictions for family employees when forming an ESOP? Is that something that you want to address later, or could you address that now?
No, now's a great time. There are some slight, it depends on how heavy the family's in there. The government has these rules of fairness rules, and they call them anti-abuse testing. These anti-abuse testing were designed for massive, gigantic companies for not getting, because they were figuring out ways of getting 90% of the benefit to the top 10 executives, which were often family members. And so it was so skewed. They were kind of ripping off. They were ripping off the employees from the government standpoint, because it really wasn't an employee benefit plan. It was a family benefit plan. And because of that, they put in these anti-abuse testing that didn't translate perfectly at smaller companies. So sometimes the most benevolent small company can get wrapped up and be deemed abusive when they're the furthest from it. But that's only in extreme circumstances. And before anybody charges any fees, we look at those things and figure out, is there a family issue or not a family issue? And there is also an issue of that 1042. If you're getting capital gains tax savings, you choose not to pay capital gains tax. The government says, look, enough's enough. I gave you a lot of tax advantages. You and your family aren't going to get shares in the ESOP in that scenario. So there's the two instances where family members may come into play. But if family's 90% of the business, we might have an issue. If family is just a couple brothers and sisters and a kid or two amongst a couple hundred employees, it's not going to be a blink of the eye. It's nothing. So it's all facts and circumstance. And just to be clear, as far as the rest of the outcomes here, the sellers get a fair market value to a ready and willing buyer. It's a non-public sale. It's a stock sale, not an asset sale, which if anybody sold a business before, from a seller, it's much preferable to sell stock than assets from liability purposes, because the liability goes with the stock. When you do an asset sale, liability stays with the sellers. You're getting interest on seller notes, the sellers are. The future equity stakes taxed half the rate or more or less than ordinary income rates would have been if you just took interest. And by the way, the sellers and their family or designees still remain chair of the board, president, CEO, still getting salary, healthcare, phone, clubs, car, board fees, perks. May or may not get ESOP. Oh, and by the way, when you don't want those things anymore, you pass the reins to your designee. I don't want to be chair of the board anymore. I want my son or my daughter to do it, or my CFO is doing a great job. I appoint them now board chair, and things just progress from that standpoint. This board perpetuates itself, and you get all these. May or may not participate in the ESOP, depending on if you took the capital gains tax deferral. And by the way, this is the time for estate planning. Really, I'm not going to get too bogged down in it, but when you get in that future equity stake, here's the lowest hanging fruit. When you get that future equity stake for bearing the seller debt, the day you get that, it's on a company who's leveraged 100%. So when we have a valuator actually value, even though later on we calculate it's probably going to be worth $6 or $7 million, but the day you get them, it's on a company that's 100% leveraged. That may be worth at that point a couple $100,000 of gift and estate tax consequences. That's the time to gift that away. The day you get those, if you don't need them, you want to get it out of your estate into future estates. The day you get that warrant or that future equity stake, they're hardly worth anything. About a 97% discount of the eventual payout. It's the time to gift that away. And that's just one example of some of the estate planning things we can do. Transfer massive amounts of wealth to future generations or charity and maximize the tax advantages of doing so. And the company's profits remain tax-free indefinitely. Here are the objections I get, and I know we're running out of time. I get ESOPs are complicated. Yeah, they kind of are, but so are many worthwhile techniques. And so those that are willing to work with professionals that explain things and you know, present it in a way, you're going to get some nice tax advantages from doing that. If you stick with it, and ESOPs are expensive. Well, that's relative. You know, and Rob, you can probably talk to this. I know ESOPs are relatively inexpensive compared to some business brokers and private equity fees. Then you also have to compare it against not paying tax on the proceeds, sale proceeds, and potentially not paying tax on the profits ever again. Rob, would you like to comment? You're much more versed in those other worlds than I.
I would say, without speaking, poorly of our friends in the private equity industry who we work with a lot in our practice here at Heffernan, to your point about ESOPs being complicated, the sale process to a private equity firm or a strategic acquirer, and the buy-side due diligence process that they undertake to investigate the operations of the business, the target business being acquired, is also an incredibly arduous, painstaking process, where they're going to look in every drawer, they're going to look under every rock to understand the operations of your business, and you need to be prepared for considerable time and calories spent addressing those due diligence questions for them to understand the operations of your business. And as far as the expenses, if you're going to hire an investment bank or a business broker, will effectively do the same thing as they prepare your business for typically an auction process to invite and entertain various bidders that might be interested in your business. That's also some considerable costs, their fees to effectively sell your business. Just like you're going to hire a realtor to sell your home. That's exactly what a business broker or an investment banker is going to do to prepare your business for sale. These are things that you need to be mindful of. That again, if you are down the road and getting to a point where you want to sell your business, these are things that we should be talking about.
Thank you, Rob. I get hey, my employees are going to run the business. We talked about that. That's not true. The board's still the board, management's still the management. Employees do not run the business, nor do they have access to information. I get, hey, ESOPs, I hear they're difficult to finance. Well, that's absolutely not true. Certain banks that understand ESOPs, they love lending to a company that's not paying income tax. I mean, they love it. In fact, it's 3 loans to the bank: the original loan, and then what they normally do is they come in and refinance your seller notes. So those seller notes do not run the term. As soon as the bank note's paid off, and the average is 3.5 year duration of the bank note because it's paid off so fast, they come in and refinance it. And then when that's paid off another 3.5, 4 years, they refinance the future equity stake. So the seller, this is a much accelerated payout than it sounded in the presentation, but banks do like ESOPs. Now, if you're interested, or somebody you know is interested, here's the process and the steps. If you're happy to do a private introduction to ESOPs like we talked about, and even customize it more if you'd like, do that as many times as you like for your advisors, your accountant, your attorney, whoever. Happy to do it, and other owners of your company. And also, we're happy to do an ESOP financial review, and even put that in writing. Look at some of the key things, such as the compliance testing I talked about, such as is the value within the realm of acceptability. Are the costs going to outweigh the benefit? Is your employee population? There's some payroll and population things that come into play. We have valuation issues, things of that sort. Be happy to do a multi-point ESOP financial review on your company at no cost. In fact, that's compliments of Heffernan. They're covering those things just as an item to help their clients or potential clients, just to see if this might be the right road. And if it's not, you're out another hour, and you're out just reviewing some things that might be helpful for other purposes. And then once we get beyond that, we go on to a preliminary valuation / preliminary analysis. This is anywhere between $10,000 and $15,000, where we give you a value you can hang your hat on for ESOP purposes. And then we model from a 30,000-foot view, what does this look like? What are the total proceeds? What are the tax savings? And what does the effect on our cash flow from a high level? Can we even think about this? That's like I said, 10 to 15 grand. And then after that, if that still makes sense, we go into a full feasibility study which might be 30 to 50 grand, depending on your size and your scope. It's usually on the lower end of that. That's the blueprint for the implementation. That's what the plan will look like. It's getting term sheets from the banks. It's recommending stock splits. That's everything you need to know to pull the trigger or not pull the trigger. And then 5 and 6 kind of go together here. And then once we decide to pull the trigger and do an ESOP, we implement. And that's when we hire the trustee. The trustee has their own counsel. The trustee has their own valuation firm. That's where the expense and the heavy lifting comes in. And during that time, we do a repurchase liability study, which is so the company can understand what their future out-of-pocket liability is going to be to buy back those shares. And then Heffernan will help you prepare a plan of saving money away, whether it be investments, mutual funds, insurance products that are designed for this, whatever the case may be. So those are kind of the process and steps. The first couple don't cost you anything. It's just to see if it makes sense for you. And then after this first 2, then we start charging incremental smaller fees until you say no, you don't want to go any further, or you decide, yes, let's keep going and put this ESOP in. I have an example here if somebody would like to see it. And then there's some contact information for me. And that's my story, and I'm sticking to
it. Great, thanks, Dan. I really appreciate that, and you know, quite a bit of information. And I would encourage anybody who's still you know, tuned in, that if you want to have a you know, if you want to have a more detailed conversation, you can reach out to Dan directly with his contact information there, or my email address, which is robertj@heffins.com, HEFFINS.com. And I can help to coordinate that conversation as well. If anybody wants to have a kind of a broader conversation around some of the other exit alternatives, around strategic acquisitions versus being acquired by a private equity firm, we can talk through some of that in more detail as well. And Dan and I can get on the phone with you together and hash all this stuff through. We're happy to do that. So with that, if there are, let me see if there's any other questions real quick. And it doesn't appear that there are any other questions that came through. So we thank everybody for tuning in, and reach out if you have any other questions, and or if you want that presentation. Yep. Thanks again, Dan, and see you all soon.
Have a good day.
Bye-bye.